Hey there, how you doing? Welcome to the channel. So today, just going to do a little stock market update on what was going on today. All right, let's see. Boom, 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 boom. I actually wanted to start with this one here, the S&P 500 ETF. So let me do. Okay. Yeah. So here we are. It's interesting today. We have another day where, the high beta people are uh, kind of getting creamed. But if we kind of take a moment to zoom out to the big picture. So this is not financial advice. This is just kind of my view on things, how I look at things. Go do your own research. But here we have in the S&P, it was down 0.5% today. It's still riding above all the moving averages. Well, it's right at the 21 day, but it's still, it's come down and pull into the 50-day, the red line here a few times in the past recently, but it's kind of still maintaining its uptrend. So now what happened with NASDAQ? NASDAQ kind of getting its butt kicked. Now NASDAQ is really in a sticky wicket here. See, the thing that's happening with this NASDAQ is, first of all, in the big picture here, it failed to get above the 50 and stay, and now it's going down. This is like, this is not financial advice, but this is more of a short setup, right? This is a kind of situation where you have, the 21 day crossing the 50 flattening out. You have this failure to stay above the 50. And this is where you get a situation where, it may very well be a trend change here. Now, it's in a longer term picture, it's really not clear, right? It takes a long time for it to reverse. If you zoom out to the weekly chart, you're still in an uptrend, and this could just turn into a big consolidation period like we had back here, or it could go on. So that's kind of where it's at. Now here's the 10-year yield. I guess the yield was going down today. So I'm on the weekly chart here. You can see that, finally we're getting some relief from the interest rates on the long term. On the 3-day chart, it went down 1.47%, the yield. So I guess that was somewhat a positive for the market, except not all parts of it, apparently. And then here's the dollar. Here's the zooming out weekly chart. Now, interesting, the dollar is kind of going up today, and you can see that the dollar got killed here. But look how it's starting to pull to this. This is the longer term 30-week moving average. And you can kind of see that this moving average is flattening out, and we're above that moving average. So you kind of wonder if the dollar is kind of making a turn here. You have the 200-day moving average is this dotted line on this chart, and it's bumping against it. But, it's going to be interesting because if it's able to hold and break out above this more recent high here at 92.50 and then break out of there, you could really get this trend change moving. So the dollar going up, I assume that wouldn't be great for gold, but yeah, gold is kind of crap. Let's look at USO, the oil. So this is kind of the proxy for oil. We can see here that this thing, it really had sold off earlier, and on this day here, and then it kind of hit the 50-day moving average and found some support today. So that's kind of interesting. And then I have the XLP. So this is the one that I kind of been in. So the XLP here seems to have been okay today. Now, kind of curious here, XLP versus the S&P. So what I can do is I have this, we can just compare to S&P. So now here I'm comparing the XLP versus S&P overall. And XLP is green. So what you see here is that XLP more recently is outperforming. So in this little period of time, you can see that the XLP has not gone down as much as the SPY overall. So that's why I've kind of gravitated towards that. Now you can see here, zooming out, XLP, you kind of pick a point here. They're about the same. XLP outperformed back in November last year, and then it kind of underperformed later on. And then here we go again. XLP is kind of zooming up again. A little bit of outperformance at this time, but it's also just more maybe a little like a beta or more movement. SPY is more stable, whereas the XLP has had some instability. So now we want to go to the, let's kind of look at the, all the high beta stuff. We'll look at GBTC. For starters, this is the Grayscale Bitcoin Trust. We'll just look at this on a 6-month chart. Yeah, this one's kind of interesting. You have Kathy Wood out there just, I mean, there's so many people like me, Kevin, and whatever, they just like follow, Kathy Wood's every word. And I, it's very interesting because basically, as far as I can tell for this generation, Kathy Wood is the Jim Cramer. And, if you were there when Jim Cramer was, during the financial crisis, he was telling you to hold on to your Bear Stearns and all the other crap he told you, and you got burnt. You kind of learn to like not pay attention to people like that, or pay very little attention to them, because they are, and just I had a video on this I think yesterday, and they're spokespeople more than they are. So you have the Wood that's a spokesperson for Tesla. Is she really ever going to come out with a case that's not bullish for Tesla? Probably never. So here we are. Once again, this is kind of like a short type of setup. It's just really crappy. You have this thing moving down now. Once again, in the long trend, a little too long there. The long trend, it's still kind of, you're still kind of in an uptrend, but you're really entering consolidation here. You're kind of flattening out. So definitely that's kind of what's moving. So we have the same pattern in a lot of these stocks. So you have, what's interesting, you have Tesla, which is showing this pattern where, look, the 21-day cross the 50 to the way down, the short-term death cross, let's call it. You have it struggling, can't even get above the 50-day. And here we can't even get above the 21-day. So this thing is really entering, in short-term to medium-term, is definitely in a downtrend. Now, if we look at some of the other ones too, let's look at what ARK is doing. See, ARK Invest, same kind of pattern here. Yeah, really similar pattern, same as Tesla. It kind of is the same deal. Can't get above there. And then if we do some of our Churchill Capital, this one's similar type pattern. It's crap, And then Enphase, similar pattern. So you can see that overall, you look at these guys, they have similar pattern. Now, GameStop is an exception. It got beat up a little bit today, but it's different. It was very strong. It's held on. But then a lot of these other ones like NEO, let's go look at the short term, and same kind of pattern. So when you see this stuff, you see a couple things. If you're out there and you're buying like NEO, I guess, DO and CCIV and stuff, and you're XPeng, and you're buying this stuff, and I don't know. I mean, conceptually, it seems to be trading much like what? Like Tesla. So, it's very hard to see much of a difference in those. So you could we could put something here. What we could do, let's remove all these averages, and what we're going to do, and let's see, how do I do the compare to? Let's see what I did over here. Compare to S&P. See how this is set up. So we have our price. Now what I can do is I'm going to take the price of let's look at Tesla, and we're going to put Tesla behind price. We're going to update it. Okay, so there's our Tesla on Tesla. So you see that the lines are the same, and I want to go out to maybe a little bit more like 5-month chart. And so now I want to, so there's Tesla on Tesla, and then let's look at CCIV. So if you look at CCIV, oh, why are both changing? Let's see. That was kind of weird. I didn't think that was supposed to, both of them are changing. Why are they both changing? That's not how it's supposed to be. So price behind price, solid thick. Overlays, let's see, is there a price here? No. No, that chart's kind of messed up. So I was going to try to figure this out, if I could figure out Tesla up here, dollar SPX here. So why can't I change this to like CCIV? And it's not working. Behind price. they're not that perfect. No data. Oh, I see what I did wrong. I see. I put a dollar sign there. That wasn't what I wanted. So, oh yeah, so finally. So here's your Tesla in green and your CCIB. So what's interesting about this, so I guess the point I'm trying to get to is you see right now they're trading very similar. So you had CCIB went up more and stuff, but like right now they're kind of both trading very similar. Tesla actually had more of a delta there, but so yeah, they're very similar. What about something like NEO? So let's look at what NEO is doing relative to Tesla. And you can see like there's Tesla and here's confirmed NEO. Yeah, up here NEO. So you can see that they're trading kind of together. So it's kind of a, it's an interesting thing. It's like these are really well correlated. So NEO and Tesla are, I guess if you want to play that game, maybe just buy one of them. So I don't know. So I guess, so here we are. I guess we have another day where, the market didn't really do much, didn't move much. We definitely have undercurrents, definitely in the small cap, so looking at IWM, small cap stuff, getting hit. So wider range, the small caps are getting hit, they're underperforming. And, really, it just is what it is. And so the question is, what does that mean? That's the part trying to figure out. There must be rotation out of these tech stocks, out of these smaller cap, medium cap tech stocks. There have to be rotation out. The price is being hit. And then the question is, will that sustain? Is that a buying opportunity? And it was kind of funny because someone was commenting on it today. It's like, yeah, well, the problem with all the dips is I don't have any money left. Like, yeah, that's, what I've been saying is like, you can't go out there and be like, I'm going to buy the dip. Oh, buy the dip. And you make a funny little song about it. And it's like, okay, well, this is a longer term game. I mean, I understand you can trade on a 1 minute bar chart, intraday, but it's still a longer term game. So you can't just keep buy. You just can't keep doing that. You will become illiquid. You will run out of money. So that's what may be happening. And I really, I don't know what to think because the stimmy checks are not really bumping us up. And I guess the question is, the rates are the rates, but these are higher rates. And if they persist now, and that was the other thing I was talking about, there was some Fed study released about inflation expectations and how, we don't expect them to be very high. And, the problem is with that, the fundamental problem is the Fed thinks they can stop inflation if it was to become a problem. But, you have to kind of understand they've already pulled out all the tricks that they can. And, what do I mean by that? They're already at 0% interest rates. They've been at zero for like ever. And they're also like doing quantitative easing. So they're printing reserves and buying bonds left and right, mortgage-backed securities, treasuries, whatever they can. They're buying, they're flooding money. They've done stuff where like excess reserves, like there's no requirement for banks to have excess reserves at the Fed or have minimum reserves at the Fed. So it's really interesting when you look at that chart, there's this big spike in it. Well, the spike wasn't banks putting anything in, it was a change in the rules. It's changing the rules to say, well, you don't need to have any reserves. For example, if the rule was you needed to have $1 trillion in reserves, and then if you had 2 trillion in reserves, then you have 1 trillion of excess reserves, right? But if you take the requirement from 1 trillion to zero, now you get 2 trillion excess reserves. So the Fed is at this point where they've done everything that they can do. And the one thing that they can't control is inflation. So that's where it's like, I mean, what benefits from it, what doesn't. I mean, you think some stuff probably benefits, but I think the problem that you have, so remember like inflation, like when you look at a stock, and now people don't really do this kind of analysis anymore because it's more fundamental, but how do you value a stock? I mean, at the end of the day, you finance, if you take a basic finance class, how do you value an asset? Well, you value it based on the cash flows it returns. If it's not returning any cash to you, then what is it worth? It's nothing. It's all speculation. And the problem that you have with these stocks is they're not returning anything, and if they're not making any money, they basically have to go out there and keep getting money, and that becomes a problem at higher rates. So that's why these little crappy companies are getting hit the hardest, because if they have to go out there and raise money, they're going to get less favorable terms. It's going to cost them more to raise that capital, and especially when you have companies that just are pure speculations and aren't making any money at all and may never make money. It's just not a good situation. So you definitely have a time where we seem to be moving towards quality right now. Just kind of boring old quality types stocks, it seems to be the direction that we're in. Now, of course, that can always change. But if rates were to continue to persist high, like even if rates, didn't move much higher right now, you can see here, back here, rates, almost at 2%, 1.9%, 2%. If you were trading this chart, so here's the thing, like if you look at this chart and say, okay, the rates, there's relief in the rates because it's going down this week. But, if you look at this chart and you were like, this was NEO, you'd be like considering like, is there a buy point here? Is there some kind of like a high, like like what they would call a TKO or a 3-day TKO, total knockout or something like that? Is there a little knockout coming here where you buy back in so it goes back up because it's going back up? So that's what I don't know about that. So if rates persist on being up, then maybe those high tech stocks are really not going to be the place to be, because so back to the valuation of the stock, it all comes down to in finance, like you have to have a cash flow, and you discount the cash flow based on the interest rate. So you would compare, you would say, okay, if I'm a company and if there's a company and the company's going to return to me $100 a year as dividends, and for the next 10 years, and you calculate the net present value of that, given the current interest rates of 0, then that's like probably a good deal, right? But if the interest rates change to the point where you can get 2-3%, maybe 4% on a 10-year bond, that may no longer, you may get a better return on the bond. And so that's the risk that happens with stocks, because at higher inflation rates, the cash flows need to be much more. They need to return higher payments to you for it to give you the return to meet. And basically with like a net present value, the way it works is you kind of you basically have to discount your cash flows. You have to pick a rate, and they use the risk-free rate, which is often the 10-year treasury yield. And so that's what you're comparing it to, because if you're a company and you're going to do something, you have money, you can actually make a choice. You can say, well, I'm going to close down my factories, close down my programming rooms, everything, and just buy some treasuries with it. If I make more money with treasuries, it's literally, companies really, they can't do that, but that's kind of the behind the scenes of the finance. But if the rates go up, you have to compare it to a higher rate. The bar is raised. The cost of the capital is more. So both the cost of the capital is more if you have to do it. Now, meaning that if you have to go raise funds via the debt market. And so that's why maybe we're seeing this stuff. And it was funny, like I was pointing out in my video from yesterday, is like, now we have reports coming out, and people, of course, are going to try to downplay inflation. And of course, I don't know. We don't have, clearly, at least by the government measures, there hasn't been much inflation. And but the problem is, if it gets out of control, what can the Fed do about it? When you're sitting there with the amount of debt that we have, you have to understand that, with this kind of debt, the interest payments on that is this crazy. Unfunded debt and interest. Let's see. Just pay interest per adult. Yeah, so you can see here that I'm not sure if this is the right one, but U.S. total interest paid $3.8 trillion. So I'm not sure what number this is. Let's see. Oh yeah, U.S. total interest paid includes household, business, state, local governments, financial institutions. So real time running. So this is interest paid. So, okay, so like a big chunk of this interest paid is the interest that we're paying on this national debt. So as this absolute number comes down, continues to go up, you have to pay more and more interest on that. And so if those rates go up even a little bit, the pie, the chunk of the US budget that is allocated to making those interest payments is, oh yeah, here we go. Interest on the debt right here. This is the one I'm looking for. So you're looking here, interest on the debt, and I think this is probably annualized, call it $400 billion. So that's a large budget item. $400 billion is just paying interest on debt. Look at our defense war is only at $723 billion. So if you're looking at it, we're paying, and if interest rates went up even a little bit, like you can easily see that the interest on the debt payment, that amount that we're paying on interest could exceed the defense budget, which is already huge. This is already exceeding probably big chunks of this budget. So this is where the problem is. This is why you can't just, create debt on top of debt forever. There's always a consequence to it. And it's just getting to that point. It's getting to that point. It's definitely non-sustainable. I mean, it's not sustainable for you in your personal finances, right? Like if you're sitting there and you're like, you have, that's the sad part. Like I had an episode on credit cards and they'll let you hang yourself. It's sad, but if you were making $50,000 a year, they'll let you take on $50,000 of debt. Well, you can't make any payment on that. Take you 30 years to pay it off, and you probably can't even make the payments. And the more that debt goes up, it's just the more and more that it goes up, just the worse the situation gets. So the budget deficit official is only $3 trillion, but here's the budget deficit actual here at $4.5 trillion. So it's really interesting because the U.S. federal spending is 6.7 trillion and 4.5 trillion is deficit. Oh, here's actual. So yeah, so the idea here is you have 8 trillion and we're spending 8 trillion a year, and geez. So you take the difference, 8 minus 4.5, so that's 3.5 trillion. So 3.5 trillion of tax money of revenue coming in, and yet we're spending another 4.5 trillion on stuff. So that's just piling up, and that's just going to be a problem. So it's very, very interesting. So I think for me, I'm just kind of because I'm not really trading. I'm not really a deep, trading. So just kind of hanging on to this slow stuff, slow and kind of like the tortoise in the hare. I'm the tortoise. I'm just going to try to just hold on to this stuff, have a little bit of protection, and that's about it. So good luck, high beta people. Good luck with that. That's it for this one.